प्रवीण डंडारिया आजा
એમને આ ત્રણેય
ત્રણેયને ભેગા કરશો
Hi Praveen.
एक काम
Sir,
करिए,
good morning.
एक काम करिए
Good morning.
इसमें आ जाएगा
How are you?
Very good pleasure meeting all of you.
All things are going good, sir, but we are badly
क्या बात है bandwidth क्या हुआ?
missing you.
Yes, I can also sense the atmosphere there. I would have loved it. Little bit safe. No, another probably month I'll start traveling.
વિષય બી તમે અહીંયા આવી જાઓ
Yes, sir.
और શરદ भी તમે બી એ બાજુ સોફામાં જ
આ
બેસી જાઓ
ત્રણ થઈ ગયા
તમે ત્રણે થઈ જાઓ આવી જાઓ
આવી જશો ત્રણ કે
હા આવી જાઓ
આવી
આવી
જશો.
જાઓ ઉની બી આવી જાઓ પેલી બાજુ અહીંયા જાઓ મળી
હા.
જાઓ ફોટા માટે એ ફોટા માટે ને ગ્રુપ ડિસ્કશન એનું ચાલી રહ્યું છે ને આવો અહીંયા આવી જાઓ પ્રાર્થનામાં આવી જાઓ ને
Yes, sir. Go ahead.
Start with first. We are starting with first question. Praveen, sir.
Bhumiland.
Update you on the what is the group's view. Sir, we'll start with the group's view on case study 1.
Yes.
Group view was divided, and primary the concern that 4,000 should not be taxable and 1,000 should be taxable. We have also discussed Schedule 3 entry, payment of stamp duty, and case of Eastern shipping.
Case of?
Eastern shipping, some Supreme Court has affirmed Eastern shipping. That was discussed.
What is Eastern shipping decision?
I have not written, but Eastern shipping Supreme Court had affirmed. I think I have written only citation, this case name, that was affirming this view that 1,000 was taxable, I think. And apne Dipesh Kumar and Informach, both advance ruling were also discussed.
Okay.
In our group also, most of the or all of us are agreed that on 4,000 there will be no GST, even though there is the advance ruling. And there are various issues that this is the common amenities does not transfer to the purchaser, and even it remains the land. However, it can be segregated decorated land, but it remains the land. So ultimately for 4,000 there will be no GST. It will be considered as a land only. And for the 1,000, we have discussed there was a division of the view. Some of that say it remains composite supply only, and it will be considered as a composite supply. Only thing was discussed that in composite supply it is a 2 or more taxable supplies. So whether land falls under the taxable supplies or not, but there is a view that
Two or more supplies, not just.
there is a view that ultimately which is not the supply taxable supplies means non-leviable, not leviable to GST, exempt, everything is covered. So ultimately it will go under the composite supply.
And sir, in addition to this, we have put in one more question adding to that. If the land value or this development charge is combined and charged as a one value, can the department have a power to remove the component of service and tax?
Okay. Can the officer eliminate?
Yes, because in Ahmedabad we have one case wherein they have picked up the value from profit and loss account, saying thereby this is a cost of development, and this we will consider as a redevelopment development cost, and we want a duty on that.
Okay.
Can the officer do that? So
I'll
case
address that.
study.
I'll touch upon that.
Case study 2.
1,000 subsequent.
Here is the question: 1,000 contract for 1,000 is subsequently entered. So for 4,000 there is no GST because it is a transfer of land, and for 1,000 18% GST for the development charge will be applicable.
Any other views?
Sir, we had discussed in case study 2 that benefit of single residential complex is not available, as this is a part of complex. So it is 1,000 would be taxable at as a works contract, and duties to be payable on that. And one of the participant also discussed Macro Marvel Supreme Court case.
And so just additionally, we also discussed whether there is a two separate contracts. Still it can under the composite supply or not, because they have entered subsequently the separate contract. But ultimately, if it is in compulsion on the part of the purchaser that they have to enter the specific agreement, it is compulsory, mandatory, then whether still it can be treated as a composite supply or not. There were minor views that it can be still be there.
Got it.
Sir, in case 33, it is basically a revenue sharing arrangement. So we in primarily discussed that 25% paid as a profit sharing, so it is not taxable. Bangalore case is there. Mark something is there. Mark MARQ. So that is, and another thing we have discussed is for 25%, if it is a residential, means from the angle of construction levy, whether construction levy, if it is for residential purpose, construction angle, if it is residential purpose, then if receipt is after due, no tax, and for other than commercial, it is taxable under RCM. The three view we have discussed in this.
So you're saying that there is a extent to the development right, there can be a RCM.
RCM for under the commercial residence, it is exempt if it is received post view, and majority view was that as it is a profit sharing, no tax should be coming in this. And sir, in this additionally one question arose that if the plot is building is built by the builder, and if additional FSI is received at later stage of time, what would be the tax implication?
We'll skip that because this is going to take time. We'll skip that point.
If time permits, we can cover, sir. Because
after the session is over, you can always ask a supplementary question.
Yeah, because in Ahmedabad, what is happening, sir, they have revised the FSI terms in many areas. So in existing building also, builders old buildings, they are getting additional FSIs and they are claiming the right of it and they try to sell that. So that is one of the issues. If time permits, please cover that also.
In addition to that, we have also discussed one issue regarding TDR is a supply or not, or it is a right or interest in the immobile property land. Is TDR is subject to GST or not?
What is the answer?
As the government has informed by notification and circular by time of supply that TDR is taxable, but when TDR is linked with immobile property, so it's a immobile property, interest in immobile property. So is it taxable or not?
So what is the answer? Some of them said non-taxable.
Yes, yes. There was a view that it's benefiting the land and therefore it should not be taxable, though government intention is there to tax by through various clarification and notification.
So the point has been examined.
Yeah, and one additional point here said some of the participants said that here the 25% is towards the land development right as well as the land consideration for land development right as well as the land. So ultimately valuation mechanism fails and again the TDR cannot be levied to the tax.
Good point.
In case number 4, this is a area sharing arrangement. So majority view is that both the parties need to get registered if they are selling it to the third party, and in that if the person getting 25% area, if they are utilizing for self purpose, ITC needs to be reversed. And another view was for 25%, there is a scope of levying a tax under RCM between a transaction between party A to B. That is person who is retaining 75% and person who is getting 25% later on.
So you are saying that the X is liable to GST.
Yes, sir. Minority view is there.
What is the majority view?
Majority view both needs to get registered, and if they are selling to third party independently, both need to pay the tax. Collect
on what? On what should they pay tax?
On the value of 25 plots, Mr. X pays the tax.
Yes, Mr. X.
Mr. X, and for 75 Bhumi limit.
But why should they pay tax on sale of plots?
Here it is actually sale of plots.
Sale of plots.
Sir, one view was there that sale of plot, if it is taxable, that is the primary view, because plots are not taxable. That is decided in question 1 itself.
Hmm.
If it is coming, then both needs to get registered and both needs to pay
Okay.
separate, because
Okay,
in
okay.
question number 3 and question number 4, the difference is revenue and area sharing. So
Right.
the position changing.
Yes, sir. Only we have also discussed that TDR, as most of the said that TDR is not liable to GST, so no GST on TDR. And again, it is plot of land, so no GST for Bhumi land or X. So ultimately, more or less, a majority was there.
Please
And in
proceed.
question number 5, the issue was residential complex, wherein the development, the builder have paid 5%. Now is intent to avail the credit. So absolute exemption or conditional exemption was discussed in notification, that what if I breach the condition of the notification and go in for 18% with full credit. That was discussed in primarily. Majority of the view that they cannot avail the credit by paying 13% differential.
That means they believe that they are stuck with 5%.
Yeah, the majority view was 5%, case closed, no credit.
Minority view.
Minority view, they tried to breach the contract condition of the notification, and as we were doing in works contract case earlier, by paying full duty and availing full credit, the same position continues. And in that we have discussed whether the condition is absolute or conditional, means that we discussed very, but I think that was not discussed in length, but it was a view.
Oh, understood.
So we have also discussed the same matter. Only issue is in notification starting para, they have referred various sections, and they have referred section 16(1) also, through which they have issued a notification for restricting this input tax credit. Whether the government has power to issue a notification under section 16(1) is the issue. They can block the credit by issue a notification and restrict the credit.
50%.
Excellent. I'll look into it.
Okay.
And sir, in this 15(2)(b), which has been prescribing the manner, and one of the speakers, one of the participants said that notification is issued under 15(2)(b), hence it is mandatory, means it is mandatory hence to follow 5%. McDonald's case was discussed in Gujarat High Court.
And
Yeah, but
just one,
15(2)(b) refers to prescribed.
Prescribed manner, and the notification is referring to that.
Okay. I'll address it.
Notification is valid, means you cannot breach the condition. You have to
But-
mandatorily go for 5%. That is the view of that one of the participants.
So in the two additional things that the like Surat said, prescribed means it is defined. Prescribed means prescribed through rules only. And one more thing, we have discussed that there is a condition at the end of the notification that you have no other option but to go with this notification only. But however, the section 11 provides that if there is a full exemption, one need to avail mandatorily that full exemption. But here it is partly a partial exemption. So notification cannot bind me to go only with that option. So if I breach the condition, I have option to pay the GST at 18%.
On what?
Yes, sir.
On what? 18 on what? Total value or reducing land?
Total value less total value less land.
Land
Okay.
one.
So land value is to be deducted. That is unanimous view. If it is 18%, land value needs to be deducted. That is unanimous view.
And the second question is regarding 5%. Yeah, Macha.
Yeah, I think same, no?
Yes,
Same.
only credit is not available at the regular time, but now it is time still available. So whether still I can avail or not.
Same discussion.
I think answer will not say change.
Sir, in
And
this,
there is
in
a
this-
second question that they can adjust 5% GST already paid and paid balance 30% to avail input tax credit as a output tax liability. This is the second question.
Sir, in next question, sixth one, nothing is majorly discussed. Only one point is discussed, that time limit to avail credit is there with me. That is, time limit to avail credit is there. And we have discussed the pre GST era. There, where in number of cases it was decided the credit taken in books is a valid credit. So if I am eligible for this 18% with credit in this scenario, then I am empowered, means the credit should be reflected in 3B is the only credit, or credit taken in books is sufficient. I may not reflect, or I may reflect credit.
Yes, Bishan, are we running out of time? What happened?
No. He is there in conference, sir.
He is just setting up the thing. No issues.
Bishan, mic.
And Praveen, let them know that I've mailed them the PPT. They can upload the PPT, and somebody can move
It
the
is
slides.
available. It is available, sir.
Okay, fine.
So in case study 6, primarily old and new regime was discussed, as earlier book credit was sufficient. So can we do or continue with this same concept right now?
7, item 7, cement royalty.
Seven.
Yes.
Sir, in 7, we are, group is of a view that the royalty. Group of is of view that the royalty amount paid to the trust should not be under the RCM, because trust is not a government, state government, central government, or local authority. So RCM should not be charged on amount paid to the trust, and objective of the trust is altogether different than the mining activity. So RCM is not applicable.
And sir, in that also we have also discussed it, royalty, whether taxable or not, that 5-member bench, 7-member decision, and pending before the 9-member
Yes,
bench.
first read it.
Sir, you stay in this link only. No need to join separate link. You have to stay in this link only, sir.
Mia,
Huh?
Yeah.
I have to stay in this link.
Yes.
Why? I won't stay.
So that whether royalty is a tax or not, that we have discussed, and there are pending decisions. And this regarding trust, majority view is that it is not reverse charge because it's government, but only some of the minority view is that whether, because the supply is by the government, the consideration has been paid on the instruction of the government to the third party. So still quid pro quo is with the government only, and therefore it can the entire amount be under the RCM or not. There was a minority view.
Sir, question 7 and 8 we skipped due to limitation of time.
Okay. 8. Yeah. So in 8, it is about this cancellation thing, and we have discussed this clause agreeing to refrain an act and tolerate an act. And yeah. Sir.
Hello. I've sent you another link. I've sent you another link in WhatsApp. Join with that. Just give a normal letter.
Details of excellence.
All get the number and all that.
Okay.
Or ask him to take a photo. He will talk to you. I've asked him to call you.
Yeah, he called me. So he told me. So I told that I'll send you.
Then we'll finish this meeting.
Okay.
Sorry, wait.
Yeah. So in this case, there were main 2-3 points. First, now schedule 2 remains only classification entry. So this transaction does not amount to supply under 7.1, and therefore I need not to go to the classification entry in schedule 2. Second point, even if I go to the classification entry in schedule 2, the term agreeing to refrain from an act or tolerate an act is a specific agreement in something positive on the part. So it's not doing something, or there is a breach of contract cannot fall under the that clause. There should be a specific agreement for the to refrain from act or to tolerate any, then only it will be liable to GST. So majority is it is not liable to the GST.
9.
9 and 10.
9, sir, what we have discussed is like this only because there is a Kolkata club.
Couple of people, Nikita is joining in. My daughter is joining in, and in case somebody else from my office joining, just let them know.
Okay.
That is Bishan's prerogative, sir.
I will inform the
We'll do it.
Yeah.
We'll do it, sir.
If he doesn't do, let him do one times like this.
No. That is not.
Sir, he will do
We'll
that.
we'll do it.
Please go
Like
ahead.
said, 9 and 10 because 9 is Kolkata club decision and there is a one positive AR also. So everyone discussed this still available. But then we have discussed this retrospective amendment and what will have the impact of the retrospective amendment. And in that case, there are majority view that once there is an amendment, now it is difficult to go out of the GST.
Okay.
So in this question number 9, the house was one versus all.
What is one versus all?
I am of the different view, and entire house was in the unanimous view. What Abhishek just told you.
What is one?
I am of the view, sir, that people may take 7,500 as per notification, exemption and pay. Let this section 7 get amended, schedule 2 entry get deleted. This, as per my personal view, have a similar impact as they did in post negative list and pre-negative list. They try to tax everything. My view is anti 29A of Constitution, wherein deemed taxing power are been given to the government, is only related to goods, wherein the entry of service is not mentioned. Hence, to throughout the mutuality out of the India itself, they need to do constitutional amendment and insert the service word in therein. And if they insert service, we have no game to play. Till they insert the word service in constitution, whatever they want to do in the act, let them do it. They have no case in their favor, sir. In spite section 7 is amended, let them write it very clearly that club and member are two people. I want to tax this, whatever, sir. Constitution once amended, game is over. Till the constitution is not amended, they have no case. That is my view, sir. And entire house, everybody was the view that once the amendment is done, your case is gone, you have to pay the tax.
Thank you, Praveen. Nice view.
Yeah.
So section case 10, sir. Everybody disagree for later. And section the view, the department, they primarily used to believe that exemption is coming from this.
I'm losing you.
Okay, connection issue.
Sir, are we audible?
Yeah.
No, I lost you because there was a freezing for some time.
Okay. Now, sir, question 10. What we primarily discussed is another situation wherein government is introducing exemption in any entry. So every officer was of the belief that from the date of exemption you were exempted, earlier you were taxable. So that we discussed with the angle of AA inserted in section 16(2), that you have now covered that online credit is only valid credit. So earlier it is allowed. So means you cannot issue a notice for a recovery and ask me to pay. That is only point we discussed in this, sir.
Unanimous view?
Unanimous view, sir.
Sir, more or less same. There is no provisions in the act and therefore matching is not mandatory and for different various reasons, but everybody agrees that there is no reversal required.
Now you all of you agree, but all of you were 10%, 5% and gungo about comparison of some months ago. No?
Sir, practical view I can tell you. Practical view I can tell you. On field, the situation is different. Just discussing with you, situation is different.
So yesterday in group, we have said that we are talking about the law. At present, we will not talk anything about practically, but what law provides, we will discuss only that. And we accordingly.
Nothing wrong. It's after all intellectual deliberations and playing around with the language and thinking how we can make, if there is a possibility of interpretation, why not? But at the same time, realities are realities. I understand what you're thinking.
Yes, yeah.
Sir, in this case, we have also discussed rule 61(5). That I have to go through, but I am done, sir, here. That is on.
That 61(5) is that 1121 amendment.
Yes, sir.
Okay.
Thank you, sir.
Thank you very much. Hello.
Good morning, sir.
Morning,
How are you,
morning.
sir?
How are you?
Fine. What do you prefer? We should change the slides from here, or that you will prefer that Nikita, or from your end you will change the slide?
No, you change the slide. No, it's better that you're in control.
Okay, fine.
I'll just
Done.
use.
So
I'll use one clue called next.
next. Okay. Done.
Yes,
sir.
Okay, thank you so much, sir.
Okay, sir. You please
Thank you.
continue in the same group.
I'll
We
remain.
are getting out.
Thank you.
Thank you.
Thank you, sir.
Wait a minute.
Bye.
Leave करो ना.
Hello.
One more. Who wants to come can come. I'm online. Want the PPT there? You have to do connections. I have it. They'll have it. In case you guys want to see, you have to bring an one's laptop or some other laptop. Indian and Bombay. Oh. One second. அதில் வந்து என்ன பிரச்சனை? No, I don't. Only get there.
Presentation is there, it's
On my system, I can give you a mail. Mail with the ID to forward. It's not so. May I?
Yes, you will have it.
and sir's views on all the posers. So now I request CA Puneet Prajapati to give an introduction of our Vaitheeswaran sir.
Good morning, everybody. It is my immense pleasure to introduce the faculty. In fact, we do not require much introduction in our group, but as a formality class, let me have some few words for him. He is a practicing advocate, and he has a very excellent knowledge in indirect taxes. And for many years, he is a regular speaker for our RRC. He is practicing in an advisory and many areas in indirect tax, legal due diligence, advisory, and other translation and trademark also. He is also a good author and has also written a number of books, and which are some of them are very 14th edition also. He is also member of various well-known organizations like WICI and CIA for indirect taxes. And besides that, as I know him, he is very excellent analyzer of
It is here also.
and besides that, he's a good person and also a good cook, which I think is today not possible for us to enter. But besides that, please welcome Sri Vaitheeswaran. Sir, now my yours. Thank you.
Sir, thank you very much, and I hope that you got the memento which we have sent you through Blue Dart.
Virtual memento.
No, sir, we sent it through Blue Dart. So
Okay.
please accept our token of gift. And as the posers were very much interesting and all have taken care of that, we will appreciate the efforts of our group leaders. So, on your behalf, we are presenting memento to all the group leaders, Abhishek, Ruchi, Sharad, Anadaji, and Praveen Dandaria, to please come forward for the same. So please, Praveen bhai. Branch and IDTC.
They're all in physical mode.
Sir, during this group discussion, one of the person who has taken pain is CA Puneet Prajapati. As a group coordinator, he has taken pain to assemble everyone and see that the group discussions in all these three groups are happened. So please give a big round of applause to everybody. we request you to start your sessions. Vaitheeswaran sir, thank you.
Can you start the PPT?
Yes, sir.
Good morning, dear friends. I know you can see me, but I cannot see you. That is the advantage of hybrid systems that we are having. And normal circumstances, I would have traveled and I would have been part of your RRC. And I've always enjoyed the deliberations as well as the hospitality in your place. Now, given the fact that the COVID has changed everything and the RRCs are technically RRCs as far as the participants are concerned, but some speakers are virtual. It's still interesting times. I think we move forward. Going forward, I predict these kind of things happening much more. So, firstly, I wish all of you are safe and are secure, and we beat this menace that has confronted us and come out successfully. And coming typically to the case studies, I had a brief discussion with all the group leaders. Pretty clearly, the group has been active and deliberations have happened quite well. And typically multiple views. But that's the beauty of group discussions. The group discussion would result in multiple views, and the minority view always becomes interesting in these group discussions. As a lawyer, I can tell you, in many of the Supreme Court decisions, if you go back in time, the minority view or the dissenting view of a learned Supreme Court judge, which was rendered, let us say, 25 years ago, become the majority view 25 years later. So sometimes in many cases, you will find that the dissenting opinion is very interesting because that will be far ahead of time. And by the time it rolls and comes back to another larger bench, you'll find that the dissenting judge's view becomes the law. So that way, I'm very happy to know that that there have been contra notes to the general sailing of the group. So I will discuss those aspects when I come deeper in. Next, please. So let me give my, like in films, you have the statutory warning. Smoking is injurious to health and alcohol consumption is injurious to health. Smoking causes cancer, etc. Like that, I'll give you a statutory warning. All the ARs are binding only on the applicant and the department having jurisdiction over the applicant. AR rulings are not decisions. They are not judicial decisions and they have no precedent value. They have a lot of entertainment value, but they may not have precedent value. And generally, you have noticed that AR rulings are always in favor of the revenue. Of course, there are 1 or 2 rulings which are in favor of assessee also. But it is inevitable because you can't constitute an AR and put sitting officers and expect them to give path-breaking rulings in favor of the assessee. So the role has to be also clearly indicated. So had there been some kind of a judicial appointment, had the AR been headed by a retired High Court judge or something like that, then things would have been better. Interestingly, unfortunately, the GST story which we all talk about, that it's quite bad, AR rulings are quite bad. The direct tax has taken a leaf out of this. So Finance Bill 2021 is amending the authority for advanced rulings, which is currently presided over by a retired judge. They are making AR irrelevant, and they're now going to create what is called as board of ARs. And these board of ARs are going to be manned by chief commissioners. So you can guess what's going to happen next in the future as far as direct tax AR is concerned. Next. So the first question and the second question is typically sale of plots. And if you look at the Gujarat AR, I just pick one AR. Let me again give a caveat. I'm not a great fan of AR. I don't put much precedence, but I know the group would have discussed ARs. Therefore, I'll just touch upon it. So the Gujarat AR, in the case of Satyaja Infratech, had ruled that purchase of land and selling said land by converting it to integrated subplots of various sizes and the name Bliss Homes is liable to GST. The activity will fall under para 5B Schedule 2 of the CGST Act and GST Act and GGST Act, and hence 9% plus 9% is applicable in terms of entry. This is what the ruling is. Next. If you look at the Madhya Pradesh AR, there was a firm which was a partnership firm which made an application. It was engaged in business of real estate development. It developed a colony by executing a JDA with the landowner. There was a revenue sharing agreement, 60% and 40%. Madhya Pradesh AR ruled that activities of applicant amounts to supply of services under WCT and liable to be taxed. The value of supply is equal to the amount received or receivable by the applicant, which is equal to 40% of the amount on which plots are sold. And thus, as per the ruling, 40% of the sale value of the plot, representing share of the value of the developer, has been treated as tax. Next. Now, let me be very blunt and clear that the AR rulings are flawed. Why are they flawed? Number one, let us not forget the fact that, let me stop for a moment and take you back in a little bit of history. You're all practicing professionals and you have gone through the service tax regime. And in the service tax regime, there is a definition of service called Section 65B44. And in terms of Section 65B44, it specifically includes any transfer of title in goods as well as immovable property. So there was never ever an intent to tax immovable property. So then what has drastically changed in the 46th Amendment to the Constitution? I mean, the 101st Amendment to the Constitution. In the 101st Amendment to the Constitution, you had Article 246 capital walking. Yes, power to levy GST is there. You also have a definition of service, which is anything other than goods. Just because service is defined as anything other than goods, will it be so wide and encompassing that it can take immovable property in its fold? If that were the intention, if that were the thought process of the lawmakers, then they would have naturally amended entry 49 and other entries in the state list which deal with land and other aspects of immovable property. Therefore, today, you look at land as an entry, it is still in the state list. If you ask me saying that, sir, they might have had this in their mind. No. If you look at the 101st Constitution Amendment, consciously certain entries in the list alone have been amended. Entry 54 of state list has been amended, whereby sales tax or VAT is only on certain products. Entry 84 of central list has been amended, whereby excise duty is only on certain products. You look at the state list again, the entry for entry tax has been abolished through 101st Amendment. The advertisement tax entry has been knocked off. The entertainment tax entry has been substituted where the municipality gets a power. Therefore, the lawmakers were very much aware as to that they were tinkering with the state list and they were amending the state list only in the context of few entries. And they did not touch, I repeat, they did not touch the entries pertaining to land. Therefore, it is very, very clear that land is outside the ambit of GST. Immovable property per se, in my view, is outside the ambit of GST. You cannot derive powers which are not there, which is conferred through the Constitution. Therefore, sale of plot primarily, without being the nitty-gritty of the transaction or how it is structured and whatever it is, sale of plot primarily is a sale of land and outside GST. Now, construction of complex in the context of construction of commercial or residential building forming part of complex and does not cover the sale of land. Of course, that 1/3 reduction and all does not mean that it is, they're taxing the land. In fact, I would say that 3/2019, in the context of construction of complex, when they provide for a 1/3 reduction of land, it is a clumsy way of saying the power to tax land and therefore we are giving a reduction towards 1/3 towards land. Fundamentally, if you had the power to tax land, you need not give the deduction. Make the deduction for the land. What is the necessity for giving a deduction from a value in the context of land? Because land cannot be subject. Since land cannot be subjected to GST, the notification attempts in its own methodology to give a 1/3 deduction. Now that is a separate issue by itself. That can you give it through a notification? You cannot, first of all, eliminate land through a valuation mechanism when you don't even have the power to tax it. It is like, you can't ask a CA final question and CA inter, no? As simple as that. It's a subject variation. It's not a syllabus at all. Therefore, if something which is not in your syllabus, you not even talk about it. Land is outside your syllabus, you can't say I'll give reduction for land. It is as good as income tax law saying that we will not put VAT. You don't have the power to put VAT. Where is the power to put VAT? So like that, we need to understand mere entries in notification cannot derive tax liability, cannot result in tax liability, cannot create interpretations based on tax liability. So fundamentally, the AAR need not have looked at the construction of complex itself. On first principles, sale of plot itself is sale of land, and therefore outside ambit of GST. Now let's look at how plots are created. In Gujarat, you know how these businesses well done, and across the country, this is all well done. See, you see lovely advertisements, you see beautiful landscaping, and then you walk in, you have a plot of land which is identified. Now, all that happens in some area of land which is probably primarily agricultural. So, firstly, somebody would have bought agricultural land and then went to government and got permissions to convert it to non-agricultural land. And after that, they would have done tremendous amount of leveling of land to ensure that it is possible. And they would have done so much of soil testing, other aspects of the land to ensure that it is marketable. And after all that, they may have to give some area for public parks. They have to gift it away, called as open area. That they have to give to the local municipality. Then they will have to involve the municipality and the local authorities for laying down roads in that area, etc. Once the permission is obtained, they call it a particular layout. And in that layout, they'll have plots, and each has corner plots, other plots, etc. All those things. Lighting is required, water is required, sewerage is required. All that is done. Then probably a gated community is created. And then you go to the market and say, look, plots are available. Are you willing? Now, there are two types of buyers. One buyer would see all this happening 10 years later and buy the land where it is in a rough state of land. There is another buyer who would buy only when this is at this stage. Obviously, the prices will be different. So the value or the saleable capability of the plot gets enhanced based on some degree of work that is primarily done. These are a rough tract of land that is sold. So, as a seller, if I am interested in selling the plot of land at a higher price, I would do all these activities. As a seller, I may get a bigger market price or bigger realization if I do all these activities. Now, take an example of a showroom. Somebody is selling phones. He can stock all the phones. But unless he puts a board outside saying mobile phones are sold here, nobody's going to come there. And the showroom has to be attractive. There has to be some kind of air conditioning, some kind of visual lighting. Market access must be there. Advertisement must be there. It does all this only to enhance the saleability of the phone. So there is a sale price for the phone. Once there is a sale price for the phone, will you go there and say, no, you pay partly for the phone, partly for looking at the keyboard, partly for entering the air conditioned premises? We will segregate these items and tax it. One of the group was talking about whether we can segregate. You cannot do. You go to a restaurant and buy a nice, what is that thing which Bishan will take me? Have more. You go to have more and have a wonderful starter. You enjoy the starter, you pay for the starter. You are not paying for different aspects of that. You are not paying for the element of ingredients into the food. You're not paying for sitting in the chair. You're not paying for access entry into the place. It is not like a cinema theater where you're getting access to watch for a particular period of time. So one transaction is there, that is sale of food. You cannot discern it, dissect it, and try to identify some goods in it or try to identify some service in it. So that is some principle which if you keep in mind, most of the answers will flow. Next. So let's look at the transaction. Conveyance is executed, covering the consideration for the land and the development. So third schedule is quite clear. Sale of land is not covered. Therefore, one primary view is that it is a sale of land, and therefore the development is intrinsic for the saleability of the land. Without the development, the marketability of the land may not be that great. Therefore, I as a owner, I'm incurring these expenditure to enhance the value of the land. And hence, even if I charge 1,000 rupees separately for the development and 4,000 rupees separately for the sale deed, it should be perceived as one single transaction and therefore outside the ambit of tax. Now, the second aspect would be I enter into an agreement separately for development charges. So there is a conveyance for 4,000 rupees per square feet, and there's an agreement for development that I charge 1,000 rupees per square feet. Now, the mode of execution by itself need not alter the transaction. Just because two documents were executed doesn't necessarily mean that it becomes two separate transactions. So one view would be to say, sir, why take risk? After all, I'm advising my client, and he has incurred these development charges by engaging a various contractor. He has engaged one mason to do all the civil work. He has engaged electrical contractor to put the wiring. He has engaged a design consultant to do all these things. Everybody is charging GST. I want an ITC on that, at least on the development portion. Be it, you are entitled to structure it. Therefore, if that is the case, it is well within your right to say, I will not pay GST on 4,000 because it is sale of plot. I am willing to pay GST on 1,000 rupees and I will take credit in respect of the development related activities. Because you have to ensure that Rule 42 is completely complied with. So I agree with the group when they said that the 4,000 will not be taxed, the 1,000 there is a possibility of tax. I also give the next option. The next option would be, in case you are willing, handle the litigation that follows, because we now are living in an era where you have to be ready for litigation. So we are living in a tax era where everything that you do is questioned, and therefore you will inevitably get a show cause notice. In fact, I would even be surprised if somebody says, no, sir, I don't want to take any risk, I will pay on everything. You will still get a show cause notice, because there will be some way they find out that you have not paid properly or you have not paid on something else. Wait for the tamasha to unfold. In your balance sheet, you will have so many other revenue streams, and based on your revenue stream, somebody can apply Rule 42 to you. These revenue streams are not even in the GST regime. We'll come to that later. So the point is, in case you want to take a position and your client is willing to take the risk of litigation, then you can explore composite supply. So from a composite supply, it is always possible to say that the development is incidental to the sale of land, and therefore it should be perceived as linkable to the main transaction and hence not taxable. Next. So my answers for case study 1 would be, a developer can purchase land in his own name, carry out all development activities, prepare the layout and sell the plots in its own name. The tax implications are, there will be obviously stamp duty and registration fees. The sale price of the land by the developer to the owner would include the margins and the development charges, and on this sale price, the property would be registered and the customer would pay stamp duty registration fee. There is no GST in the hands of the original owner since he is selling land, and there is no GST in the hands of the developer since the developer is also selling only land. I would say that the first land is, it's like the school days. You get a book, and then when you're going to school, you have to get your school books. You will get rough book, science book, maths book, etc. And those books are useless unless you cover them with an attractive brown cover and put a label. But just because you put a brown cover and a label, etc., and write your name in capital letters, it doesn't cease to be a book. It still remains a rough book, or it still remains a science book. So these are all puffing. So there's enhancements that is done does not change the character of the land. In my view, it is still outside GST as a transaction. Next, please. Now the answers to case study 2, conveyance for land as well as development agreement. On the sale price paid to the owners, obviously developer will have to pay stamp duty and registration fee. On the sale price for the sale of plots to customers, the customer would pay the stamp duty and registration fee. And on the sale of land by the owners to the developer, there is no GST. On the sale of plots by the developer to customer, again, there is no GST. As I said, as an option, you can identify the development as a separate consideration, or you can treat it as composite supply. I leave it to you, but depending upon your client's appetite for a possible dispute at a later point. Next, now, stay there. Now, for you to take a view that development charges are not liable to GST, let me give you some interesting perspectives. There was a decision in the case of, in the service tax regime called as hallmark infrastructure, where the tribunal, Chennai bench, held that service tax cannot be levied on the consideration collected as land development charges. The tribunal accepted the argument that development activities were undertaken before sale of land, and hence the service is a self-service, and there is no service provider, service receiver relationship. The relationship starts only at a later point of time. Only after I've done all these work, the customer is interested, the market is interested. So what I incur and what I do is only self-service at that point of time, and self-service cannot be subjected to GST. I mean, service tax in those days are not GST. And as I said, development is also critical for the plots to be identified as marketable. Then one question that would arise is, sir, composite supply definition refers to one or more taxable supplies. I can see the audience now. So the composite supply refers to one or more taxable supplies. So when you say one or more taxable supplies, when land is not even considered as a supply, can you apply the definition of composite supply? Basically, composite supply is the philosophy of natural bundling. The idea is that the transaction should be roped. One interesting case came before the Gujarat High Court in the case of torrent power. So in the case of torrent power, the question that arose was, the principal supply was transmission distribution of electricity, and that cannot be done without your electric lines, electric plant, electric meters. Principal related ancillary service go hand in hand. One cannot be provided independently of the others. These are clearly composite supply of services. Tax liability is written by treating such composite same as supply of principal supply. Since transmission distribution of power is exempt, the tax liability of related services is also exempt. Now, what is interesting to know is that electrical energy is outside the ambit of GST itself, because electricity or taxes on electricity is still a state subject. So GST notification saying that electricity is exempt is only reflecting the legal position that they cannot tax it. So even though something is identified as exempt or non-taxable, fundamentally the taxable supply would encompass within its fold anything which is leviable as well as anything which is exempted, including anything which is non-leviable. Therefore, you can borrow the definition of composite supply to take a view that the development charges are incidental to land, and since land is kept out of it, development charges should not be taxed. Next. This has already been covered. Next. Now moving to case study number 3, where I think many of the groups had discussed the concept of revenue share, and the majority view was that revenue share cannot be taxed. And there were also views on what happens in the context of TDR, whether development rights can be taxed. And then one more view was that the 25% that is being paid is not only for the land, but is also for the development rights. And therefore, in the absence of a mechanism for determining how much is the value of development rights, the whole thing will collapse. All interesting views. I agree with all the thought process in the group. Now, let me give you some perspective. Facts: developer sells the land, he gets money. Money comes into the bank account. Out of the money that comes, 25% of that sale proceeds is given to the owner. So, landowner receives some money, original landowner. First question is there a supply by landowner? Now, the next aspect is, even assuming landowner is identified as giving development rights for consideration, can development rights be subject to GST is the next question. Then the third question is, you already have notification number 6/2019, which tells you how to deal with development rights and which recognizes when development rights is taxable and what is the consideration for such development rights. And throughout the language of 6/2019, you will find that development rights are discussed only in the context of consideration. Therefore, can it even apply to a monetary consideration paid for development rights? That's the fourth question, which I'll attempt to answer. Next. Many of you would have already examined this. As far as development rights are concerned, you might have also heard me in many of the seminars which I've attended, which I've participated as a speaker, either in Ahmedabad RRC or in CTC or ECAS. I've been consistently maintaining this view till now. I've not altered my view on this, that development rights cannot be subjected to GST or service tax as the case may be. Development rights are nothing but rights which flow along with the land. They arise from the land. They can be identified as benefits arising from the land, and therefore they must have the character of immune property. So if you're looking at specific performance agreement for use of TDR, the court has observed that TDR benefits are arising from the land, and therefore it is an immovable property. That is the decision of the Chennai Housing Development Corporation, Bombay High Court. And even as far as land is concerned, right to take soil, right to take minerals, fishing rights, so many rights have been identified as immovable property. And one other aspect, interesting aspect in GST is that we are also having an additional condition: supply for consideration, supply must be in the course or furtherance of business. So when a landowner gives this huge tract of land which he has inherited to a developer under an agreement whereby they enter into a revenue share agreement, can you say that this is a transaction in the course or furtherance of business? The landowner to be taxed. So from that perspective, if you look at some of the judgments of the Supreme Court is that both of the parties to the transaction must be perceiving it as a business transaction. It cannot be a business transaction from the standpoint of one party and something else from the other. A single transaction where an owner of immovable property agrees to sell his land to a society may or may not constitute a business transaction, depending upon whether the seller is in the business of selling property for profit. So in the landowner, is he in the business of selling property for profit? Answer is no. He's just holding the land and getting into a development agreement with the developer. Developer is in the business of selling plots, no doubt. But developer is in the business. He may have a taxable supply, he may not have a taxable supply. The landowner, when he gets the 25% share, he is not engaged in business. And therefore, applying the Banushali decision also, one may possibly conclude that there is no business and therefore there is no supply from the landowner. Next. And it is not as if we are talking in the thin air. Development rights taxability has been examined in the service tax regime, and we have the decision of the Chandigarh bench of the tribunal in the case of DLF commercial projects, where it has been clearly applying all this Chedda, Pendre, all those concepts. The various decisions in the context of immovable property have been applied, and the tribunal has said that development rights can be considered as immovable property. So one is that development rights can be immovable property. Two, landowner is not engaged in business and therefore it is not a supply. And you also have an interesting decision of the AP High Court, where this transaction is very interesting. One person had got into a joint development agreement, and then the question arose whether he has to pay wealth tax or not. So he said, look, I'm a landowner, but I've got into a joint development agreement business, and therefore this land is my stock and trade. So if land is stock and trade, I cannot be subject to wealth tax. The API Court said that when purchase of property is an isolated transaction on execution of JDA, it cannot be said that the owner of land also intended to carry on business using the subject land as stock and trade, since he might have very well decided to part with land for other reasons. So you have, my thought has always been to look at various decisions from various tax laws and non-tax laws, get principles, get theories, and then apply it wherever possible in theory. So if you look at wealth tax decision, you get this answer to say that it is not stock and trade. If it is not stock and trade, how can you call it business? And therefore, they've examined the concept of business in the API Court decision and said that landowner is not engaged in business. The answer we want. So if the landowner is not engaged in business, the landowner is not engaged in supply. Next. I think many of the group members got this answer correct when they refer to the Murmugao Port Trust case. Very interesting case. This is in the context of revenue share model. Before I go into revenue share model, let us say that Bishan, Praveen, myself, and Abhishek decide to go to a restaurant. And we get into a big fight as to who should pay the bill. So I want to pay the bill. They said, no, how can you pay? You're a guest. We'll only pay the bill. And then between them, they fight as to who should bear the bill. So finally, we come to an agreement that instead of fighting like this, let one of us pay the bill. And after coming out, we'll all share 25% each. So Bishan foots the bill. And when he comes out of the restaurant, all of us give him, the rest of three of us give him 25%, 25%. Now Bishan has got 75% of the bill in his pocket because he has paid 100%. Can you tell me that Bishan has provided restaurant supply services? If you say that Bishan has provided restaurant service supply to the rest of the three, then I have no case. But if you tell me, sir, this is cost sharing, he has incurred the cost and therefore he has only recovered the proportionate cost. You apply that theory again. Who is the service provider? The restaurant is the service provider. Only one service that is provided. Then the next is distribution and arrangement. So here the Murmuga Port Trust is an interesting case where they said when two people jointly undertake a common enterprise and agree to share the revenue between the two of them, there is no service inter se between them. That is the beauty of this. Together, they decide to do something. Their interface is the client. Client gives the money. After the money is received by them, they share based on the revenue sharing model. Okay, you contributed this, I contributed this, we'll give you this amount of share. Then the question was, when the money is received to one of them from the other, can you say that there is a service or inter se supply of service? So the last part is very important. There is no service rendered by the appellant, and the money flow to the assessee from SWPL under the nomenclature of royalty is not a consideration for rendition of services, but in fact represents the appellant share of revenue arising out of the joint venture being carried by the assessee and SWPL. So by the same logic, the landowner and the developer together have joined together. Landowner says, I have land. Developer says, I have market, I have expertise, I can make this land wonderful, marketable plots. And together they decide that, okay, I will give you possession of the land. You do all the leveling, you do all the development, you do get all the permissions, you do all get all the NOCs and clearances, you do the electrical lighting, plumbing, sewerage, etc., the advertisement, make it marketable. And once you start selling, you give me revenue, whatever you receive, 25% has to come. A very fair arrangement. So the fundamental transaction remains a sale of plot to the customer, and out of that, what is given does not become an inter se service between the owner and the developer. And that is why revenue sharing model is still a very relevant thought process to say that there is no tax as far as case number 3 is concerned. Next. Now, just to give you a little more flavor of these decisions, Mumbai bench of the tribunal held that mere flow of money from one person to other cannot be a consideration unless there is any specific activity carried out for this. So here again, the activity becomes critical. What is the supply which the landowner does? How can you say landowner has supplied anything? And even if you say he supplied anything, he supplied land. And land is out of the equation. So either way you look at it, in a revenue share model also, there cannot be a GST. And interestingly, Supreme Court judgment, which some of you discussed in the context of mutuality, they said that while there cannot be any service tax on a club based on the principle of mutuality, and also held that there has to be an activity carried out by one person to another for consideration for service tax to apply. So where is the activity carried out is a very, very important point for answering these questions. Here again, the Allahabad bench held that in a revenue sharing model, the appellant was not a service provider and not providing any service, and therefore was not eligible to pay any service tax on the income received under the agreement. Now, I can also give you the Apollo Hospital judgment, which I handled. The question is typically in hospitals, what happens is that sometimes they get into a management agreement whereby some element of the fees is shared, and some element of the services is provided by one more agency or one more entity, and the hospital does one more services, or sometimes they could have an arrangement with the doctor in the hospital like this. In all those cases, we have argued that the portion of the fee collected by the hospital and retained towards collection charges or facilitation fee is also in the nature of healthcare services and not liable to service tax. So when a patient walks into the hospital, they may have to go through an administrative mechanism of registering the patient, recording the patient, taking his database, and therefore there is an administration charge or collection fee, etc. But ultimately, it is part and parcel of the healthcare service, and healthcare service is outside the ambit of service tax, and therefore the tribunal held that this also will have the character of healthcare services and not liable to service tax. Therefore, this analogy is equally applicable, and the share of revenue from the sale of land can also have the character of revenue from the sale of land. So if it is like, in a buffet, you guys must have had a wonderful buffet at the facility in Rajkot, and mixing the Gujarati food. So if you're walking through the buffet, and let us say you go to a paneer sabji, and you use there's a big utensil of paneer sabji, and you put one particular ladle or something to pick up a little bit of paneer sabji and put on your plate, it remains a paneer sabji. So you cannot say that what bigger utensil has paneer sabji, what I have to plate is something else. So the amount that comes from that is also land. So what was sold is land, what is distributed is proceeds from the land. That will also have a character of consideration towards land. And if you apply that analogy, then revenue model also there is no question of land. Now, I don't know how much of this is done in Gujarat, but in other parts of the state, there's something called as a power of attorney transaction. So in a power of attorney transaction, what happens is that the landowner gives the power of attorney and permits the developer to develop the land into plots. So let us say owner gives the power, developer on the strength of the power starts working on various things and then starts selling the land and getting a share of profits. First question, is there a sale of land in the hands of the owner? Now, department may take a position saying the absence of transfer of title is not sale of land, and therefore landowner has supplied a service to the developer. It's a very interesting case which is still fighting in the service tax, where the department has tried to say that whenever a power of attorney transaction is involved, ownership does not pass because conveyance is not executed. Since conveyance is not executed, landowner remains the owner still, and therefore whatever money he gets is nothing but real estate services liable to service tax. This is one aspect. The second aspect is, now no developer will work on the strength of the power of attorney. He will get a power of attorney. He will get an agreement for sale. He will get possession of the lands. Otherwise, he's lost, completely lost. So he will get full possession and he'll pay money under the agreement for sale. So he would take a stand in his books that I have purchased land. You look at the developer's books, even in the context of power of attorney transactions, once possession has been given and money has been paid, you will say 53 of Transfer of Property Act is applied, and therefore this transaction I would recognize as purchase in my books, and therefore the developer will say this is stock, I have purchased. Seller will also equally say that it is sale of land and offer it for capital gains for income tax. Next. Mumbai bench of the tribunal, in the case of Viraj Estates, has held that purchase and sale of land does not fall under real estate agent services. Department had contended that consideration received cannot be considered as sale proceeds, as one cannot sell something which one does not own or has title to, and hence the activities are in relation to sale of land. That was not accepted. I'll probably give you a simpler example of, let us say, a car. Now, you may buy a car. So when you buy a car, what happens? You pay the applicable motor vehicle tax, and the car is registered in your name with the RTO, and the Vahan ministry recognizes that you are the owner of the tax, owner of the car. After a few years, you decide to sell the car. Now, when you sell the car, what happens? You go to a second-hand car dealer who's an expert in this field and tell him that, look, I want a car to be sold. Whatever refurbishing you want to do, you do. So you give the possession of the car to him. He does the refurbishing and then he sells. And he says that he has purchased the car from you and he has sold the car in the market. But remember, the name transfer for the car will not happen in favor of the second-hand dealer. The name transfer will happen only in favor of the ultimate buyer. So you sign all the forms and hand over the forms to the second-hand dealer, a second-hand car dealer, and he will ensure that the title is transferred from the car from you to the ultimate buyer. Now, there have been disputes as to whether service tax is applicable in this transaction, and courts have consistently held that this is also purchase. This is also purchase because all rights in the car has been conferred on the second-hand car dealer. Just because RTO has not recognized or you have not done a name transfer, it doesn't matter. It will be recognized it is not as a service. Even in the context of VAT law, when there is a resale tax for these kind of transactions, courts have confirmed that resale tax is applicable because the first transaction is already a sale. This is a second transaction. Next. There is a decision in income tax, a very interesting decision called the Sanjeevi Lal, Supreme Court. So what the Supreme Court said that by executing an agreement to sell in respect of removal property, a right in person is created in favor of the transferee vendee. And when such right is created in favor of the vendee, the vendor is restrained from selling the said property to someone else because the vendee in whose favor the right in person is created has a legitimate right to enforce specific performance of the agreement if the vendor for some reason is not executing the sale. This is a very important principle which I always tell. I mean, as a firm, we practice real estate apart from property transactions. We do it apart from taxation. in property transactions, it's very, very important. And as professionals, you also get into transactions for buying and selling of property for yourself or your family. You need to be very, very important. Title is very important. All the more important is to ensure that your seller has not entered into any other agreement with any other person to sell the same property before talking to you. So that covenant is very, very critical. That commitment is very, very critical, because in case your seller had entered into an agreement to sell the same property to somebody else and paid an advance to that fellow, then that fellow is an agreement holder. He has rights to insist that the property must be sold to him. So unless that agreement is formally cancelled, this entering into agreement with you would not be legal. And therefore, it is very, very important to understand what is the right that flows from an agreement for sale. So that is what Sanjeev Lal Supreme Court explained, saying that when a right is created in favor of someone, the vendor is restrained from selling the property to someone else, because the vendee in whose favor the right is created has a legitimate right to enforce specific performance of the agreement if the vendor is not interested in executing the sale deed. That is why Supreme Court applied this logic and said that in the context of Section 247 of the Income Tax Act, one can say that if a right in property is extinguished by an agreement to sell, capital asset is deemed to have been transferred. So they said that this would apply, this would attract capital gains even in this kind of a transaction. It's a very, very interesting judgment which can be explored for understanding further principles in these matters. There is a decision of the Allahabad High Court in CIT versus Shimbu Mehra, where it is held that moment an agreement to sell is executed between the parties and part consideration is received, the transfer for the purpose of 50C takes place, and computation under 48 will start accordingly for the purpose of calculating capital gains in Section 55. Of course, there are views to say that unless and until conveyance takes place, there is no sale of land. But in all these cases, you would notice that the agreement to sale would have been followed with possession. So possession of the land becomes a very, very critical element of the transaction. This is an interesting case. I'll give you a background on this before I go into this case law. A lot of times what happens, the biggest concern for in real estate business is stamp duty. When a bigger landowner approaches, let us say a developer, or let us say a bigger landowner approaches a buyer and says, can you buy this land from me? Now this buyer, if he's buying for investment purposes or owning purposes, will pay the money, get the sale deed and be happy. But this buyer is some kind of intermediary where he's just going to look around in the market to get a higher price for the same plot of land. He will not be interested in getting the conveyance in his name and paying stamp duty, because he has to pay the next transaction again hit stamp duty, and therefore he's not very, because fundamental logic, stamp duty is not in GST and he cannot get input tax credit. So look at the way it all unfolds. Land is outside the ambit of GST. Stamp duty cannot be availed as input tax credit. Registration fee cannot be availed as input tax credit. Therefore, cascading continues in real estate transactions. So an intermediary or a trader would prefer not to have the conveyance in his name, but use the power to execute the conveyance in somebody's name. Now, is there a risk here for the original owner? There is some element of risk. The risk is that, look at these facts. In the case of Kasturi versus CIT, the assessee entered into a sale agreement in March 1993 with the firm for providing for delivery of a property to the firm on receipt of the agreement for sale consideration, which in fact was received in August 1993. The firm took delivery during 1994, power of attorney executed in 93 after obtaining NOC from Income Tax Department Chapter 20C. Those of you who are seniors in this audience would know that Chapter 20C of the Income Tax Act existed some time ago, whereby if you want to sell an immovable property and the price was, let us say, more than 20 lakhs or 25 lakhs, I forgot the number, then you have to go to an authority called as appropriate authority and knock the doors of the authority and say, this is the property which I'm going to sell. This is the agreement for sale. This is 35 lakhs. What do you say? That authority will find out what is the market value for the land. In case the authority finds out that the market value of the land is actually 50 lakhs and you have put only 35 lakhs, at that stage itself, he will not give NOC and the appropriate authority will buy the property from you at 35 lakhs. So the whole idea was to curb black money transactions and evasion. Therefore, if you show lower value of the agreement than the market value, you ended up selling the property to the income tax department. So the funny part of it was, you go and knock the door. I've appeared those days before the property authority. You go and knock the doors. They'll be very keen to buy certain properties. I'll always ask, what are you going to do with the property if you buy this? Nothing. They'll buy the property, put a board saying ownership of income tax department, property authority. It will not be sold at all for donkey's years. And finally, the same fellow will come and buy. Otherwise, some commissioners were very practical. They looked at the transaction and used to give an NOC. So in this case, NOC was obtained. Therefore, transaction went through. Partners who had obtained the POA started selling the property in parts in 1995. And the capital gains was offered with assessee in the relevant assessment year in which possession was granted. Which means 1994, he has given possession, he has offered capital gains thinking that he has sold the land. Now, our fellow did not pay the tax properly. Therefore, he filed a petition to section 264 saying that my capital gain will arise only when the other fellow starts selling plots or the land. And therefore, he wanted the capital gain to be postponed from this year to the subsequent year. This commissioner did not accept under 264. Writ petition was filed. Madras High Court rejected the claim and held that ingredients of 53A were satisfied when the assessee had put the other fellow in possession after receipt of full sale consideration. So very, very critical for us to understand that sale can be recognized, ownership transfer can be recognized, purchase in the hands of the other can be recognized if you have received money and you have put the other fellow in possession. So if that is the facts of the case, then we can very well say that the owners had already sold the land, and in this hand also it is sale of land. The money going to him is only sale of land and consideration for sale of land and can never be taxed. So as I said, these are the critical things: possession, full payment of consideration or an agreement, rights must be conferred on the developer. How do you treat an income tax? I will recognize that sale has happened, transfer has happened in income tax, and then you recognize the impact in GST by saying that I've recognized the transfer has happened, and therefore I am the owner of land, I'm no longer the owner of land. The money is only for sale of land. However you call it revenue share, you call it area share, etc. The money that I receive is only in lieu of sale of land. Now moving forward, another favorite topic of mine, whether 5% is the only option. All of us are aware that notification 3/19 came to the landscape, and 3/2019 is a lengthy notification. It will take time to understand, and by the time you understand 3 pages, you'll get confused again, go to the first page again. And because you read the first page again, it will confuse further, and therefore you go to the second page and you're lost. And then you start looking at commentaries to understand. And commentaries, with due respect, every author has given their own dimension, and therefore you'll be further confused. Then you'll come to this brilliant conclusion that none of this will work. Let me read FAQs. And FAQs will take you on one more journey. And finally, you will realize that I don't understand this completely. I'll simply pay 5%. So the problem is that I won't blame the professionals. I will not blame anybody who says I'm not able to understand this real estate notification, because it is very badly done. It is drafted assuming and usurping powers that do not exist. And to say that 5% without ITC is the best way option for everybody is completely defeating the concept of GST. Well, why did you bring GST? You brought GST by saying that there is cascading effect of tax. We need to bring global tax reform. We need to match the rest of the world in terms of tax reforms. We need to ensure that there is an equitable taxation in the entire supply chain. Input tax credit is very critical. After saying all that, you bring on 5% without ITC. See, I would not even condone the 5% for the restaurant. Because a lot of people say that, sir, restaurants are cheap now, food is cheap at 5%. What is wrong with it? It is wrong because you have defeated the concept. You could have very well kept 8% with ITC. Nothing wrong. How much of ITC is a restaurant is going to get? Or you could have kept 12% for a big size restaurant for ITC. His rent will have GST. His maintenance will have GST. Whatever branded foods he is buying, he will have GST. So when he does, his packing material will cost GST. All that is cost now for a restaurant. Imagine construction. No credit on cement, steel, iron, aluminium, plastic, contractor, subcontractor, security, maintenance. design, advertisement, architect, you can't give credit on anything. Imagine the cost spiral that will happen for a builder. Therefore, builders after some point of time are thinking again, is there a rainbow in the horizon? Unintended, because the client is the case study is rainbow developers. So the rainbow in the horizon is, can I ignore this 5% and can I take the input tax credit? And the facts of the case, this fellow had charged 5%, but had also availed ITC. So the question is, can the department say that you have to reverse ITC because you have paid 5%? Or can the department ask for higher rate of tax? So let's look at the transaction. Developer pays GST on 18% on the construction consideration, 18% charge on the customer, 5% charge on the customer. 18% charge on the customer is one option. Second option is to be, because customer market is very, very strong. He charges 5 on the customer, but balance he pays from the pocket. Land, he doesn't charge anything because he says consideration of land, no GST. And ITC is available. So is this option available? I think the groups have examined this very well. They've gone in depth and read the notification. So notification 3/2019 amends 11/2017. 11/2017 is perceived as a rate of tax notification. Unfortunately, it's beyond that now. Because if you read 11/2017, it is issued in exercise of powers under 9.1, 11.1, 15.5, and 16.1. Let's look at basics. You are all aware that the charging section under the CGST Act is section D. Charging section provides for a levy of GST on intrastate supply at the rates notified. Do you see anywhere in 9.1 the power to impose condition for rates? It only says you can levy GST at the rates notified. Rate notified means it's a number, that's all. You can't open one more column and say 5% subject to ABCD. 9 doesn't give that power. There is no concept of a conditional rate of tax notification. There is only a rate of tax notification. Therefore, I don't think the conditions can be attributed to 9.1. Next, notification issued under 11.1. 11 gives the power to grant exemptions. Now, an exemption can be absolute or partial. An exemption can be absolute or conditional. An exemption can be full or partial. An exemption could also be a concessional rate. So I would read this notification as like this. The 5% is a concessional exemption rate notification subject to APC conditions. One of the conditions is don't avail input tax credit. Therefore, if I perceive it as an exemption notification and a conditional notification at that, then I'm entitled to ignore the conditions and say, I don't want the exemption. Now, I'll take you back to income tax again. In income tax, you get depreciation on under section 32 of the income tax. One fellow did not claim depreciation. The income tax officer said, "Arey yaar, why are you not claiming depreciation?" That fellow said, "I don't want." ITO said, "Nothing doing. I'm giving you depreciation. You have to claim depreciation." Matter went to Supreme Court. Supreme Court said that depreciation is his choice. You cannot trust on it. Then to nullify the decision of the Supreme Court, they made a depreciation mandatory. Like that, in excise, people used to say, I don't want exemption. Exemption means I can't get SENVAT credit. I will pay duty and claim the input tax credit. So section 5A got amended to say, if I give it, thou shalt take it. If I give the exemption, you have to take it. Then interpretations came saying that if you give an absolute exemption, I have to take it. If you give a conditional exemption, nothing like that, I don't have to take it. So here, it is not an absolute exemption, it is a conditional exemption. Once it's a conditional exemption, I can forego the 5%, which is an exemption, and say, I don't want the exemption, I want input tax credit. I'll pay the full rate. Third aspect, notification is said to have been issued under 15.5 of the CGST Act. You go and read 15.5 of the CGST Act, it says prescribed, as may be prescribed. Prescribed is defined in the CGST Act as prescribed through rules. which means if you want to prescribe anything under 15.5, you must draft rules for it, not notifications. Therefore, notification 3/2019, when it refers to 15.5, collapses. Then comes this marvelous reference to 16.1. Just because you quote 16.1, you cannot say that I can put conditions of non-available income tax credit. 16.1 does not give that power. 16.1 grants credit, does not restrict credit. If they had been smart, they would have put this provision in 17.5, which bars credit. They should have put this in 17.5 as a category, saying that such of those companies, business who are availing lower rate of tax are not entitled to input tax credit, notwithstanding anything contained through 17.5 mechanism. Having not done that, none of this will survive. Therefore, in my view, reference to 16.1 has no relevance. Reference to 15.5 has no relevance. Reference to 9.1 has no relevance. Only relevance is 11.1. 11.1 makes it a conditional exemption. If it is a conditional exemption, I can walk out of it. So this is a summary of my thought process. Power to notify rates is simple power, and there is no power to specify conditions or restrictions. Power to grant exemption does not confer power to provide a deeming fiction. Their option is not exercised. Non-availability of ITC can be specified only through 17.5 and not through a rate notification. 16.1 does not confer power to deny credit. 15.5 requires rules to be framed, which is not done in this case. Next. Next. So lower rate with conditions is more under section 11 in the form of an exemption. And therefore, the principle is if exemption is absolute, assessee has no choice. But if exemption is conditional, assessee at his option can choose not to avail the exemption. Enough number of decisions are available in the excise regime. Therefore, in my view, assessee can choose to ignore the conditional exemption and discharge GST at 18% and avail ITC. Therefore, as far as first question is concerned, what the department is saying, you paid 5%, but you availed ITC, therefore you are wrong. What should the department do? They cannot ask me to reverse ITC. They can collect more tax from me. I'm willing to pay because I have the ITC to pay. Situation 2, I have not yet availed ITC. I have the time to avail the ITC. Therefore, I'm entitled to ITC by ignoring the option that is available. Moving on further. If ITC availment was wrong and 5% rate was not available, then full rate of GST would be payable, but that cannot be on the land component. Obviously, because land cannot be taxed. Given the nature of the condition, it would be possible to take a position that 5% method is not the only method. Therefore, construction segment can attract 18%. ITC would be available. Land segment or undivided share segment would not be liable to GST. Next, please. Now, question number 7 will take some time. I'll take about 15-20 minutes in this. First of all, we need to understand that government owns resources. Government is the ultimate owner of all the natural resources. And the government would enable private sector to walk in on obviously by paying some amounts. Government is not in business. If we understand these fundamental principles, then we can understand what is this seigniorage that is paid. Sometimes they call it seigniorage, sometimes they call it royalty for mineral rights. That's a big branch of law. Mines and minerals law is a big practice by itself. There are lawyers who made their career in mines and minerals practice. So, if the activity of the government in granting mining rights does not constitute service by the government and it's a sovereign function, then one can possibly say that there is no service involved and therefore it is not a supply. So let's discuss this next. Government is the owner of the natural resources and exercises sovereign rights in conferring licenses for mining and collects royalty or seigniorage fee. How can you perceive it as an activity of service provided by the government? Entry 54. Of course, you may argue saying that, sir, for telecom they've said this, for this waves they've said this. What do they call it? The spectrum they've said this. They've given notification. They've said that. I again repeat, an exemption notification does not presume that there is a tax liability. An exemption notification is the draftsman over enthusiasm to keep something out of tax so that confusion does not happen. In fact, I would even go on to say, even without Schedule 3, land cannot be taxed. even without Schedule 3, land cannot be taxed. And just because Schedule 3 land is there, doesn't mean that if it had not been there, it was taxed. You cannot tax something, you cannot put there, it's only for abundant caution. But if without Schedule 3, employee could have been taxed. Because employee clearly provides service to an employer. There is a supply of service. And therefore, in the absence of Schedule 3, there is a potential for a big disaster. And all the employees would not strike if GST had come. So that is why they were very clear that you don't want to tax employees. So coming back, entry 54 union list, 7th schedule. Mind you, this is union list, not state list. Deals with regulation of mines and minerals development to the extent to which such regulation development under the control of the union is declared by the parliament by law in public. Therefore, this is completely a different subject as far as dealing is concerned. Next. This is a famous decision of the Supreme Court. 7-member judge of the judgment in India Civils case. Lot of controversy around the judgment, interpretation of the judgment, parawise, dissection, dissection of the judgment. All that has happened. Why this much of controversy? Let's look at what Supreme Court said. Royalty is a tax. Any imposition of cess by the state on royalty being a tax on royalty is beyond the competence of state legislature, since Section 9 of the Central Act covers the field and state legislature does not have competence under entry 23 of this. Cess on royalty cannot be sustained under entry 49 as a tax on land. Royalty on mineral rights is not a tax on land, but is a payment for the user of the land. It is therefore clear that if royalty is a tax or an imposition or a levy, it is not on land alone, but is a levy or a tax on mineral, labor, and capital employed in the extraction of the mineral. And therefore, it can only be a tax, but on the other three things above. Now, once India Cements decision gave an indication that it is a tax. Now, the question that is now pending in various courts is, can you say that the royalty that I pay to the government would attract GST under reverse charge mechanism because government is a supplier of service and I am a recipient of service? If royalty has got the character of tax, then I think people should start paying GST on income tax also. Because you pay income tax to central government, you pay VAT on petroleum products, you should start paying GST on VAT also, because they're paying VAT to the government. All the dealers should pay. So it leads to absurd conclusions. So if something is a tax, you cannot call it consideration for another tax, provided we are able to accept the theory that royalty has got the character of tax. A very interesting judgment of the Calcutta High Court. Now, this is a case of the Star Paper Mills in the context of Income Tax Act. The question arose in the context of royalty payable with assessee as per a GO relating to obtaining raw materials from the forest of Uttar Pradesh government. The Calcutta High Court said that the government is the authority to decide the rate of royalty. If it is a contractual liability, then fixation of rate of royalty can be only with the government. On these peculiar facts of this case, they said that royalty liability cannot be perceived as a contractual liability. And then they applied India Cements logic and said that when royalty has been held as a tax with apex court, and the rate of royalty can be fixed ultimately by the state government, and its recovery can also be made only in the case of land revenue, it cannot be treated as a contractual liability. So if it is not a contractual liability, then you call it as a service. Then comes Kesoram Industries. All minerals form part of land. Minerals are conceived by Mother Earth by the process of nature and nurtured over innumerable number of years and delivered on their assuming value and utility for the earthlings. Generally and broadly speaking, and that would suffice for our purpose, a mine is an excavation in the earth which yields minerals. Mineral is something which grows in a mine and is capable of being won or extracted so as to be subject to a better or precious use. Until extracted, remember the word, until extracted, the mineral forms part of the crust of the earth. A mineral right, according to Black's law, is a right to search for, develop, and remove materials from the land. It also means the right to receive royalty based on the production of minerals which right is usually granted by a lease. I'm reading it specifically because it's a very interesting judgment. Next. Then Supreme Court said, royalty is not a tax. The impugned cess by no stretch of imagination can be called as a tax on tax. The impugned levy also does not have the effect of increasing the royalty. Simply because a royalty is levied by reference to the quantity of minerals produced and the cess is also quantified by taking into consideration the quantity, it does not become royalty. Next. Then the Supreme Court said, what happened in India's case? Supreme Court in para 56 in the Vaitheeswaran judgment referred to the earlier edition of India's case and observed that in the first sentence, the word royalty occurring in the expression royalties as tax is an error. What the majority wished to say, and has in fact said, is cess on royalty is a tax. They never said royalty is a tax, but they said cess on royalty is a tax. The correct words we printed in the judgment should have been cess on royalty in place of royalty. The word cess on appears to have been inadvertently or erroneously omitted while typing the text of the judgment. This is clear from the reading of the judgment in its entirety. While para 22 and 31, which preceded para 34 above, said their lordships have held that royalty is not a tax. Even the last line records royalty and mineral rights is not a tax, but a payment for the user of the land. So now we are back to stage one. You have the Vaitheeswaran judgment which said India Cements meant only this and did not mean the other way. Next. In the context of service tax, demands were raised in the levy of service tax and royalty. Supreme Court has stayed the demand of service tax, and the matters are pending in the case of Udaipur Chambers of Commerce. And the question is now whether before the Supreme Court, now mind you, the issue is now pending before 9-member judgment of the Supreme Court. What is the question? Whether royalty payable on minerals extracted as provided in the MMDR Act is the nature of tax is one of the questions pending before the 9 bench. The other question that is pending is whether the scope of entry 49, how much can it be extracted or how much can it apply is another question pending before the 9-member bench. Please understand, the last or the recent 9-member bench that we saw was entry tax in the general case. It's an elaborate judgment which completely defined the levy of entry tax and confirmed the levy of entry tax. This 9-member judgment is going to be a path-breaking judgment on multiple concepts, including mineral rights, including royalty, including what is immovable property, including what is land. We'll have to await this decision to understand, and our thought process can completely change based on the decision that comes at a later point of time. So as on date, I'm not able to give you an answer. We are still fighting the battle to say that there is no service involved. So now let us take it a bit forward. When I pay royalty for getting the right to exploit the mine, or when I'm conferred rights to take out the mineral from the land or mineral from the mine, I may possibly say that government is exercising a sovereign function and therefore it is not a supply in the course or furtherance of business. That may be an interesting argument. Instead of focusing entirely the argument that royalty is a tax. If I'm able to establish that the government is exercising a sovereign function and such sovereign functions cannot be called a supply in the course of furtherance of business, and say that government is not engaged in business in this kind of activities when they give, only they can give. See, I cannot take. It's like a king giving rights. Sovereign is like king. It's like, if you watch Crown, you would know the power that the king had at earlier point of time before the democracy set in. So if you look at the king, he has certain powers. So like that, sovereign has certain powers. The government owns all these rights. And there are issues in terms of how the rights are conferred. You're well aware of the controversial cases that are going on in the country as to how the rights are conferred. Therefore, it is some kind of power that is exercised by the government in their ownership rights. That is why even if you look at the FDI policy, there are certain restrictions on where investments can happen. So all that if you put together, you can probably make out a case to say that there is no supply in the course or furtherance of business, and hence reverse charge should not apply. That should be the argument going forward. Next. Case theory number 8. Now, as far as facts are concerned, property had been taken on lease for running hotels. Lease had been committed to take the property for 33 years. COVID pandemic, strategy was rethought. And as per the agreement, because there was a premature termination, so-and-so company was required to pay a compensation of 25 crores. Property owner thinks that the compensation of 25 crores attracts GST. The assessee thinks that the ABC thinks that it is not. So we are looking at two positions. The group had analyzed 7.1. Group had also analyzed 7.1A, and the group had come to a conclusion that 7.1 is a definition of supply, and after the amendment with retrospective effect, 7.1A has made Schedule 2 a mere classification mechanism. Which means unless and until a transaction meets the test of it being a supply under 7.1, you cannot borrow or infer from the language in Schedule 2. Therefore, if agreeing to or not agreeing to any obligation is specified in Schedule 2, that by itself cannot become a supply unless 7.1 conditions are met, and it is treated as a supply as far as 7.1 is concerned. So if you apply that logic, the question is whether compensation has the character of consideration. So if you look at section 7.1 carefully, supply for consideration. That means I am a supply for consideration. You must take consideration for my supply. That for is very, very important. It is a bridge to both these sides. Supply cannot exist unless there is consideration. Consideration cannot exist unless there is supply. So that for becomes very, very important. So by that logic, when compensation is paid, what is the supply? 25 crores is paid. But where is the underlying supply for that? What is that fellow supplying for getting the 25 crores? That is a key question. The recent decision of the larger bench of the tribunal in the context of service tax is equally applicable in GST. Because what happened in the service tax case in Redco, the bank had collected, the finance company had collected foreclosure charges. See what happens in all of your financial wizards. I'm talking to Gujaratis and I know that your knowledge in finance is much, much more than what I have. But in a typical finance transaction, when you are giving out a loan, you have factored the cost of taking that money out and giving it to this fellow, you have factored the interest that is receivable, etc., etc. And suddenly this fellow comes and says, I've got a lot of money, I'll foreclose the loan. So if he decides to foreclose your loan, your entire calculation goes for a 6 because you have worked out a certain ROI based on this lending transaction. And therefore, you would have contemplated that and said that if this fellow comes back and suddenly forecloses, I would suffer so much of loss because of what I had to pay. Therefore, this will be the foreclosure charges you put in the agreement. So the question arose that when somebody forecloses a loan and pays the foreclosure charges, is it consideration for a service? Matter went to court, and the larger bench has given a fantastic judgment by saying that foreclosure is like damages. You go to basic principles of contract you contemplate there is something called as breach of contract. And a breach of contract can result in damages. Damages can be agreed in advance, quantified in advance. So there are a lot of interesting case laws on what would constitute compensation, what would constitute damages, what would constitute consideration. So what larger bench said, the amount of damage is clearly stipulated in the contract, and there is no element of service that is sought to be rendered by the bank to the borrower. Contract has been broken by the borrowers for which the bank is entitled to claim damages. Foreclosure charges are nothing but damages which the banks are entitled to receive when the contract is broken. Clauses related to damages for foreclosure are incorporated in contracts as an agreed measure for damages which can be enforced. These clauses do not, I repeat, these clauses do not and cannot give rise to any consideration. That is a very, very important point. Once it is not consideration, there is no question of GST. It has to meet the test of consideration. Next. So as I said, you cannot apply Schedule 2 straight away because it has to meet the test of supply under 7.1. And there is an interesting decision of the European Court where there is a cancellation option for cancellation of hotel booking. And if hotel booking is cancelled, the cancellation charges were retained by the hotel. The European Court of Justice said that there is no direct connection with supply of service. Therefore, it is not liable to VAT as far as Europe is concerned. The group is unanimous. Recast of 7.1 and introduction of 7.1 has resulted in Schedule 2 becoming a mere classification mechanism. So if you apply that logic, let's go to case study number 9. So case study number 9. Can you say that the residential welfare association is engaged in the course of furtherance of business. I think Praveen touched about it as some point of view in the context of the 47 in the context of club. But somebody also, I think they talked about it. I'll give you a very different perspective. Most of you, at least some of you, will be living in apartment complexes where there is an association. Let us imagine this. 8 flats are there. 8 flats, possession, owner, the developer gives the possession to 8 owners. 8 owners walk into those flats. Out of those 8 owners, 4 of them are non-resident owners, therefore they let out the property. So there are 4 tenants and 4 owners. First, they have to decide whether tenants should be called to a residential welfare association meeting. So they come to the brilliant conclusion that only owners will be allowed and tenants will be kept out of the meeting. In some associations, only 4 owners meet. And these 4 owners decide what should be the monthly maintenance for running these 8 apartments. Now, mind you, as an apartment complex, what is your cost? You have to pay for lift maintenance. That's the biggest. You have to maintain the common area, and therefore there will be a servant engaged. You have to pay the servant. You have to pay power bills, electricity bills for your lights that are there in the common area. Then there is a security watchman. You have to pay for the security watchman. So these are the 4 primary payments. Additionally, water may be required or sewerage treatment may be required. Those are additional payments depending on the requirements. Now, these are basically cost which has to be incurred in common. And therefore, they decide that monthly we'll fix one amount. So let us say they fixed in this case, because the size of the apartment, they fix as 9,000 rupees based on the square feet. Or they'll fix based on square feet. And out of the 4 owners, 2 fellows have to pay 9,000 rupees. 2 fellows have to pay 7,100 rupees. And the rest have to pay, let us say, 6,000 rupees based on square feet calculation. Now, what will you tell me? You will tell me, sir, read the exemption notification. Exemption notification says up to 7,500 exempt. Beyond 7,500 taxable. 2 fellows are paying 9,000. We'll pay GST for that. Other fellows are less than 7,500. No tax. Yes, notification is quite clear. But the question is, can you tell me that this association has supplied any service to its owners? Even forget the mutuality, even without going to mutuality, even assuming they are separate, can you say that the association has rendered any service or supplied any service to its members when all it is doing is collecting money and paying the electrician, paying the electricity bill, paying the water bill, paying the security bill, and paying for the cleaning of the common property? Once you go into fundamental and ask this question, then association is not providing a service. Even if you say, sir, this is all service, then is it in the course of business? Because supply requires in the course or furtherance of business. What is the association business? It's a headache. You have to manage this every month. You have to collect this and pay to everybody. There's no business profit because nobody will fix rates which are, significant profit. It's not a profitable business. If at all, they'll collect something for capital, for painting, etc. in the future. Therefore, I am not even going to any other issue. I am going to a simple issue to say that, is it an activity in the course or furtherance of business? Now comes the decision. The committee meets. The Vaitheeswaran sir has said that, it is not even a supply. Stop paying GST. Then the other fellow will say, see, today I'm a president. In my period, I take a decision. 4 years later, department comes with a show cause notice. Another president comes. He will blame me. Why should I take a risk? Let us pay. That's how government is collecting GST on associations. GST on association is collected only because of the fact that the office bearers do not want to take a risk, or they don't want to take something which will come back 4 or 5 years to because they still live in the flat. Already there is a dispute because the president is not able to see eye to eye to the secretary. And the treasurer is in the ground floor and is very unhappy paying maintenance because he says, I'm not using the lift. Why should I pay lift maintenance? So these arguments are still unresolved. So we don't want a GST dispute also coming to the association meetings. So legally you may have a case, but practically people decide to pay. Coming to the mutuality principle. The mutuality principle, of course, I had this opportunity to appear in that matter along with various other councils, the Calcutta Club matter in Supreme Court, where Supreme Court laid down a brilliant judgment. It's a celebrated decision to say that even after the 46th amendment to the Constitution, there is no way sales tax or VAT can be imposed on a club or an association because mutuality principle will apply. And by the same logic, their lordship also held that service tax cannot apply in a club or an association. Now, a question arose whether this decision can apply to GST. My view was, yes, it applies to GST. 2 persons are required even for GST. And hence, since 2 persons are not there, mutuality will apply. Club and members are one and the same. Association members are one and the same. Somebody went to AAR and asked the question. Normally, when you go to AAR and ask the question, you will get an answer which is against you. Suppose you ask, sir, it is 5% or 12%, 12%. 12% or 18%, 18%. 18%, 28%, 28%. Exemption not taxable, taxable. So that is how you get these answers. But sometimes you get rare decisions also. So Rotary Club, when they went and knocked the doors of AAR, they got an AAR ruling saying that mutuality is applicable, Calcutta Club decision will apply. There is no question of GST on a Rotary Club. Who knows? Government wants to nullify even AAR judgments are in favor. This seems to be the thought process. So they have attempted to nullify this with retrospective effect. Next. New clause in 7.1, Finance Bill 2021. Activities or transactions by a person other than an individual to its members or constituents or vice versa for cash, deferred payment or other valuable consideration. And they add an explanation just in case you don't understand, because the explanation is normally put in the statute, because when they draft the section, that must give clarity. Only when they themselves have doubt, this will interpret like this, etc., they put an explanation. And sometimes explanation, Roman 1 explanation, Roman 2 explanation, Roman 3 income tax. If you read section 9, multiple explanations. And then the other explanation saying that it is hereby clarified. That will mean that whether it is prospective or retrospective. So now what they say, it is hereby clarified that notwithstanding anything contained in any other law for the time being in force or any judgment. So there may be probably spelling that within bracket Calcutta Club or decree or order of any court, tribunal or authority. Authority is the AAR fellow. The person and its members or constituents shall be deemed to be 2 separate persons, and the supply of activities or transactions inter se shall be deemed to take place from one person to another. So, 2 deeming fictions in one explanation, just to nullify a poor club from escaping from a GST, and then to retrospectively from July 2017. Let's take the reality. After Calcutta Club happened, there were different approaches by different clubs. One set of clubs believed that Calcutta Club is equally applicable, and therefore they did not pay GST. One set of clubs said that I have input tax credit, my member is paying, I don't want to go back to fight the Supreme Court again, I will rather charge my members. They charged. Third fellow paid GST and applied for refund saying tax is not applicable. So there are 3 kinds of actions as far as clubs are concerned. Now this amendment is sitting and staring in their eyes. And of course, they have to delete the para 7 schedule because it is no longer relevant. My view is that while they have attempted to nullify the decision of the Supreme Court in Calcutta Club, number 1, they should not have done it retrospectively. Now only Vodafone controversy arose. You had this Vodafone Supreme Court judgment income tax. Then Mr. Pranab Mukherjee amended the act with retrospective effect of 1962 to nullify the decision of Vodafone. Normally, when retrospective amendment comes and hits domestic fellows, they only cry and complain in conferences and budget seminars. But when retrospective amendment comes and hits a foreign fellow, he decided to take the matter to court, and that fellow dragged India to arbitration. And after long months of arbitration, India lost the case. So an award was passed against India. Now India is saying it's my sovereign right, I can always change the law whenever I want, and therefore they're fighting the arbitration. In the meantime, because the amendment was retrospective, Kane Energy lost the case because the assessment was taken out. Retrospective amendment come into force. So Kane Energy also initiated arbitration, and they also won the case in award. And they now want to attach government of India assets outside because a lot of money was taken out from Kane Energy. Now, India wants $5 trillion economy. India wants to be the number 1 economy in the world. We want to beat everybody in Asia. We want to grow. We want foreign investments to pour in. We want GDP to grow at phenomenal levels. How will all this happen if we keep on tinkering with the law retrospectively? Mr. You have a vision. I fully endorse this vision that India should become a super economic power. I'll be very happy. $5 trillion economy was a brilliant plan by our Prime Minister. Should we not take steps to meet the vision of the Prime Minister? If $5 trillion economy is your plan by so and so period, every amendment should move towards that. In fact, it is the other way around. The vision gets curtailed every time with these amendments. Each time you make retrospective amendment, in fact, they always say future is uncertain. In tax laws, past is uncertain. Because you can always get the law amended. So you're always paranoid, you're always worried that something can change, something will be nullified, something will be notified. We should get rid of this. These are all old concepts. I agree. You know, the various governments have always tried that, but at least now, when you want India to move forward and get this kind of growth in this kind of economy, we should stop tinkering with the law retrospectively. Yes, you don't like a decision, you want to amend the law, you want to put the tax code from tomorrow with effect from 1/4/2021. Do it. Give clarity. That gives certainty to business. You can't keep on amending the law. This is one aspect. The second aspect is amendment is also inadequate. Because what did Supreme Court say? Supreme Court said there is no consideration flowing from the member to the club. Supreme Court did not only talk about 2%. Supreme Court also said, refer to the contract law principles, refer to consideration principles, quoted a mullah book and said that there is no consideration when a member pays something to the club. It is only a share of the cost which the club is incurring for his services on his behalf. Supreme Court said, club is a principal, the club is the agent, member is the principal. The agency is procuring various things for the club from the market and giving them at subsidized rates. That subsidized rate is not consideration, and therefore there is no question of service tax, there is no question of VAT. Now that has not been addressed here. In my view, battle number 2 will start. One more round of litigation. Probably it will go to Supreme Court at some point of time. Whether I am available at that point of time, I don't know. But definitely, it will go to Calcutta Club came to Supreme Court after 20-25 years. It had a round of huge battles, etc. We'll have to see when this matter lands up before courts. But definitely interesting days ahead. But I fundamentally feel that they should look at how much of GST am I going to collect from clubs and associations. Why cannot I be much more philanthropic and say all residential welfare associations are out of GST? You get more votes also. Because the kind of the relief that you can give to various retired people that sitting in the houses wondering what is the GST and how to comply with that. That kind of, you should have a vision. Where should you tax? Where it is revenue oriented, where you can really collect the tax easily. You should tax. And half the time, most of these retired people who are sitting in these residential welfare associations, they're all part of WhatsApp University. And therefore, they read message day in, day out. And if you have an association, you'll have professionals also. So there'll be a chartered accountant or a lawyer who will say nothing doing, we'll fight the case. There's no question of GST on this transaction. Another fellow would say, no, there is a question of GST. So there's no unity also in those things. Why even get to that territory? So my view is that all associations, welfare associations, regional welfare associations, or clubs and associations should be simply kept out of the ambit of GST. It makes tremendous sense rather than continuously tinkering with the law. Next, please. The last case study. All of you are practicing chartered accountants who are your bread and butter is based on filing of GST returns. Many of you at least. I don't file returns because I'm a lawyer. I'm not into compliance. But I know this landscape. I know because for advising clients on GST, I should equally know the procedure. I know how the system works or how the system does not work. So obviously, I've seen clients who have received all kinds of notices saying that your GSTR 3B does not match GSTR 2A. Your GSTR 3B shows 1,000 rupees, whereas your GSTR 2A shows only 100 rupees. Pay the difference of 900 along with interest penalty, etc. And then they quote various provisions saying that we have all the powers. So let us first understand. GSTR 2, GSTR 1A, GSTR 2A, and GSTR 3 never came. I have to pause for a moment and go back in terms of time. in July 2017 and earlier, when in many seminars, many professionals have eloquently explained, saying that as soon as you upload your GSTR1, it will automatically reflect in your GSTR2A. You upload your purchases in GSTR2, it will automatically reflect in the supplier's hand in GSTR1A. Like passbook, you match both these things and enjoy the credit. And some of us argued, saying that it is not going to work. Of course, we were called pessimists at that point of time, but I had my doubts as to whether the technology can grapple with these kind of returns. And in fact, I was one of the earlier professionals who say that you cannot have 3 returns in GST. Then, of course, government at that point of time said that everybody is saying 3 returns, only actually 1 return. How it is 1 return? In the sense that at least 3B is a 1 return. But those days they used to say it's 3 returns. And there's only 1 return. But there were 3 returns and in the statute. The entire act was designed on the assumption that the matching would work. But once you disable GSTR2, once you get rid of the possibility of the recipient looking at the purchase transaction, then you can't insist on this comparison. So when the matching mechanism is not functional, the payment of GST by the taxpayer is only by GSTR3B and not by GSTR1. Non-reflection of invoice in GSTR2A does not impact the ability of the recipient taxpayer so long as he is able to satisfy all other conditions, section 16. And the icing on the cake, the Finance Bill 2021. Next, please. In my view, 43A, which was brought in, was never notified. And therefore, that percentage formula of 20%, 10%, 5%, all of them are paper. They have no power. There's no source. Even though GSTR2 was never implemented, Rule 61 was substituted from 1121. All those exercises don't have the sanction of law once you read section 16.2AA. 16.2AA for the first time says that the ITC availment condition is contingent upon the supplier uploading GSTR1 and the recipient seeing it reflected in GSTR2A. Therefore, after 16.2AA becomes an act, that is, Finance Bill has to become Finance Act, therefore it becomes an amendment. But it will not come into force till it is notified. For it to be notified, 29 states have to amend their section 16.2A. All that will take a couple of years. And then a notification will come. And then only 16.2AA will walk into the statute books. That means till that point of time, any exercise of comparing GSTR2A with GSTR1, I mean GSTR3B with 2A is an exercise in illegality. That can be a fundamental objection to any notice that is issued. Last point, even the 16.2AA can be challenged on the ground that doctrine of impossibility applies. How can I ask my supplier to upload the return and insist that he must upload the return? He is in your jurisdiction, not my jurisdiction. I can't go and punch his button and upload his return. He has raised an invoice. I've paid him. I've paid the GST. What more can I do? I'll prove to you that I've received the goods. I'll prove to you I've received the services. I'll prove to you I've got the invoice. I'll prove to you I've made the payment. What more can I do? Therefore, it is impossible for me to make the supplier file those returns. And on that logic, if I'm able to establish the case, then I can argue that the 16.2AA may also have to will also have to face the test of validity, because the other condition is already in Delhi High Court. One of the conditions which the supplier must have paid the tax to the government account, that condition has been tested before, is pending before in a writ petition Delhi High Court. So we'll have to see how it goes as far as this new 16.2A is concerned. I think I've reached my last 5 minutes. With that, I would conclude my discussions as far as today is concerned. I'm so glad that we are able to breach the COVID fear and do a physical conference. I wish I could have been there, but probably next time, better times I'll be there. Thank you very, very much for a very patient hearing.
Thank you very much, sir. We all are eager to hear you, and many of them had asked me refund that Vaitheeswaran sir is not coming physically, then definitely you should grant us refund. So, but sir, today's session made much fruitful to all of us. Sir, as you have said about cooperatives, that is the ninth proposal. So far as the cooperative movement and rights in the constitution are concerned, we can definitely say, and we all are agreed that they should exempt this. If there are any questions to anyone, yes, Praveen wants to ask something. So, please, Praveen, come forward.
Sir, in this poser file, you said that by rules, only the method can be listed, conditional and optional exemption. Can make any condition mandatory to follow?
You're talking about the 15.5.
Sir.
Yeah. 15.5 allows power to specify value. Power to specify value would not mean that there can be a condition that non-availment of ITC is a condition. See, for example, if you look at 3/2019, it is ridiculous. It says you cannot avail ITC, you will have to buy only from registered suppliers, up to 80% you have to buy from registered suppliers. If you don't buy beyond that percentage, this will be treated as a reverse charge mechanism. You know, it is like one do's and don'ts kind of thing in a box. That kind of box kind of conditions cannot outsource to any of those provisions.
So means if they amend rules,
Even then the challenge will survive.
it remains conditional.
Yes, yes, yes.
Thank you.
Anyone? So, sir, I now request CA Rajendra Nagar to present vote of thanks.
It's always a pleasure to listen to you. And RRC has been synonymous with your presence. So we are very missing you this time for the pandemic reasons. But nevertheless, we enjoyed the deliberation that you had regarding the poses that you had posed and the answers that you have given. So it has instilled a lot of belief in us that whatever we were thinking of taking and helping our clients to get over those notices. So those belief has been further strengthened with your beautiful remarks and your confidence that you have instilled in us. Thank you so much for the deliberations, and I, on the behalf of the Animal Branch, RRC, wish you a vote of thanks and just hope that next time we meet soon on the RRC. Thank you, sir. Thank you so much.
Good. Thank you so much.
So,
on that note, I'll take leave. Thank you so much. Bye-bye.
Yes, sir, and the lunch is ready, so we all are proceeding for the lunch. And
now I'm angry. Bye-bye.
Thank you very much.
Thank you.